On this episode, we talk about gold, we talk about Bitcoin, we talk about inflation, we talk about meme stocks, and we go all the way back to the 90s with Ben's charts. Welcome to Think at Heart. All right, welcome to another episode of Think at Heart. I'm Scott Goodfellow. This is Ben Hart. We're the Hart Investment Group. This is the, you're watching us on YouTube and or listening to us on Spotify and any other podcast platform that you may have. If you're watching it on YouTube, please like and subscribe. It really helps us out. And or comment. That would be great too. If you're like, oh wait, no, you're not allowed to leave a comment. It's banking regulations. You're not allowed to do that. I think we have the comments turned off. If we don't tell compliance. We'll do that tomorrow, I promise.
Do it.
All right, Ben, how you been? I haven't been here for a couple weeks. You did an interview last week. Hasn't released yet. We got a few nice interviews in the can now. I've always wanted to kind of have a lineup there, so that's exciting. I was away last week on my 20th anniversary. Little getaway to the cottage with the missus. I know. Seems like it was yesterday. Were you at my
20 years, man?
Were you at my wedding?
I helped to plant the flowers down the pathway and at the wedding.
Okay.
I was there,
You were
man.
there. I don't remember.
I remember the SL 500 that you and the boys drove around in.
Yeah, that's right. I look back on those pictures and it's super cheesy. You know, you look back when you're a kid at your parents' pictures and you're like, oh my God, this is the worst. And then now I look back at my own, I'm like, oh my God. We just continued the chain. Anyway, we digress into our personal lives, and but good to be back.
Yes.
I felt feeling a little out of sorts here, so you're gonna have to keep me on track today, Ben. Normally it's the other way around, but you're gonna have to keep me on track today. And while I was away, exciting news as well. The Hart Investment Group team is growing. Made a key hire.
Excited.
Key hire, customer service. Expert, we'll call them for today. I don't know what their actual title is, but we'll brought somebody in to kind of relieve some of the duties from us, so you can focus more on the investment side. I can focus more on the content. We have a huge laundry list of things we want to do. Again, you from the investment side, me from developing more content, because it's just, there's only so many hours in a day, and we got to make sure that we service our clients properly. So we're growing the team. You only have so much time in the day. So that's the only way to do it. Get a little leverage, and we've done that. So stay tuned for big things from the Hart.
Excited.
I'm excited. Super excited.
Yeah. They're going to be on here sometime too. We'll have to bring them in.
Yeah, for sure. Today I have my, it's kind of ghetto actually, but I have my Go One More Bear Performance mug. It's like a plastic cup.
I like it.
I'm 8 years old here. So don't
I have a plastic cup too.
It's basically the same thing. It has the top, like a shaker thing. I like to take the supplements and pretend that I actually go to the gym, but that doesn't happen. I just like taking vitamins. What can I say? I like to take the vitamins. I like the protein shakes. But again, Ben, you're supposed to keep me on track here. Like, what's going on?
Yeah, let's go. I almost sidetracked you with I was watching some of the triathlon swimming today that I was going to talk to you about, but let's save that for another conversation.
Well, since we're down the rabbit hole, I did my first cross the lake swim last weekend at the cottage. That's a 1,500 meter swim there and back. So no training, obviously grossly out of shape, and just laid it down. Ben, you've done that swim as well too, kind of. And
it's terrifying. It's terrifying.
It's not bad. It's not bad. No, my 16-year-old daughter does it now.
It's not bad. Yeah,
no problem.
That's true.
So maybe one day you'll get there.
Prefer the side stroke. Is the side stroke swim that you're allowed to do?
Whatever gets you there and back. Whatever makes you comfortable in the water.
It's not my strong suit. It's not my strong suit. That's for sure. I'm glad that the running and the cycling it allows me a chance to catch all of the swimmers in races.
Well, An image of you swimming is kind of like an image of me running, Ben. So it's very simple. We all have our strengths and weaknesses. All right, let's get into the
That's true.
actual things we're here to talk about today. Before we got online here, we talked about some of the topics. You came up with a couple of real boring ones, so we may as well start with those and end with something more exciting.
Definitely.
So, what do you want to start with?
I
Gold?
like it.
You want to start with gold? That's always a
Sure, let's
that's
talk
always a
about gold.
snoozer. Let's get into
Hey,
it.
that's right. You know, it's I've learned a lot about the gold market in the last we'll call it 10, maybe 12 years. You know, it's been something that I hadn't really paid a lot of attention to early in my career. It's been something that I thought was a much more challenging space that I didn't really want to learn about. Then I partnered up with a guy who was an expert in the space, and so I learned quite a bit about it, and continue to learn about it. And you know, the gold price tends to really move inversely to what happens to bond yields, so and real interest rates. So you know, you tend to track what happens to gold through that time frame. But I was listening to Hugh Hendry this week. I don't know if you know that guy, recognize that name, but he was a hedge fund manager that made, I think he made 50% in 2008. He was on the right side of the trades, kind of saw things coming in a bad way, and then went hard on gold after it got crushed, and ended up making, you know, a couple 100% in a really short time frame. And so he kind of talked about what happened in 2010, 11, 12, where all these gold producers started to say, you know, they're printing money, all the central banks are printing money, gold can only go one way. If there's this much money in the system, gold's going to go vertical for a decade, and we're gonna go crazy and blow our brains out. And you had the biggest producers of the world at that time, like BHP, spent 25 billion dollars in 2012 trying to invest in this R&D and mines and things like that, and really kind of screwed up the gold market for 5 years. And then gold sold off hard for a number of time, and now we're starting to kind of come out the other side of that. But as gold has recovered, and a lot of these companies are trading at huge discounts, where you know, you look at like a Newmont Gold, which is probably the best gold company in the world right now. They're a high quality dividend paying company. They have like traded like 15 times earnings. They make more cash than most of the top 10 companies on the NASDAQ. So you're looking at these businesses and they look kind of cheap as they ever had. And we're starting to enter a phase where we could really see gold start to pick up. Yields have kind of started to sell off in the U.S. market, and there's potentially some huge risk reward opportunities in the gold market.
Yeah, I mean, you've been pretty quiet on gold in the last, you know, it seems like. And how is gold correlated to crypto, for example? Is that the reason why nothing's really been going on in that space because there was such a run on crypto, or is it not correlated at all?
I'd see there's some correlation. I guess over the last 5, 6 years, there have been kind of a risk-taking inverse narrative, right? Like we had a period there where cannabis took off and those companies really ripped. And then you started to see money kind of cycle out of that high beta risky stuff from cannabis into crypto. And then I'd say some of the gold people would say that maybe the small cap gold space hasn't done as well as it should because of crypto. I'd say maybe there's some validity to that, but I still think it's a different market. Like I still think they coexist, and gold companies and gold stocks and precious metal like bullion trades with the institutional money still. It's still something that they trade kind of inverse to yields, where crypto is still kind of in a different category, in my
So
opinion,
if
anyways,
Bitcoin
altogether.
though, like, because this has been the big argument, right? Like, if Bitcoin is
Hmm.
uh, the future store of value, right?
Yeah,
What does that do to
yeah.
the current store of value, which is gold?
Yeah, so you'd have to be a pretty serious believer, maximalist to think that
Hmm.
crypto takes over the world. So I think that crypto plays a major part in the future of finance. But, I guess the same argument would be, do you think that central bank digital currencies exist too? Or do you think that the independent version, the Bitcoin, the Ethereum, all these places are the only ones that survive? So like, is there only one winner out of this? And if you think there's only one winner out of this, then, maybe you're right. Maybe it is crypto, but I don't think there's one winner out of it. I think gold, which has been a store of value for thousands of years, continues to hold some of that. Bitcoin, I do think plays a role. I'd say crypto plays a role, but I also think central bank digital currency also plays a role. So, I don't think there's one winner, and that, we'd have to be in a pretty strange period in the world where there's only one winner that comes out of this.
Point. Okay, what about anything else? Yep.
But as for just as for Canada, I mean, Canada has, the majority, Canada and Australia have the majority of gold mining companies listed on their exchanges in the world. So, there's some amazing companies in Canada. And you look at even some of these explorers in the mining space where you probably don't hear about it or see them. But, there's one company that I think I mentioned a couple of weeks ago, Ethos. It's up 100% in the past 2 weeks. There's these companies that have this asymmetric return profiles that you have to do a lot of work to find them and look for them. But, there's some reasonable businesses that, you can add in small quantities that can contribute to the bottom line.
Okay.
Yeah.
Any more on gold? No.
No, we can. I think as things evolve, it'll be interesting. We can talk about it, but I still think it's kind of early in the next phase of the gold cycle.
Okay, that was good. That was not as boring as I thought it was going to be. That was actually quite good. Good job, Ben. I know you have a nice chart for us in your next boring topic. So, what? I'm just trolling.
Yes,
but let's hold off on that for a second. We're going to come to because you have a chart. Let's go to that later.
Okay.
Let's add in, since we're talking about store of value and Bitcoin and whatnot. Let's skip right to that and get that behind us. The Bitcoin 2021 conference was in Miami last week, I believe. And a lot of cool things came out of that, besides several new fresh COVID cases from 12,000 people being together all in one place. A lot of people tweeting about that they got home, because people flew in from all around the world. So people tweeting in, so they got tested positive for COVID when they got home. Anyway, I digress. Interesting things came out. I was following it on Twitter. I was following it on watched some of the clips on YouTube as well, and a few interesting things that came out of that. And I think this is kind of the synopsis where a lot of people, not just my view, but a lot of people are kind of getting this view now of cryptos are really turning into three things, which is, number one, the culture of it, right? The culture of people thinking that there's going to be like a decentralization, right? That you definitely have kind of that revolution type, right? And the culture behind those types of that type of thinking. Number two, and I think to me is the biggest one, which is the technology play of this. I think it just brings finance and really just the internet 3.0, as some people are calling it, to the next level of how we interact online on a regular basis. I think it's just the next evolution of the internet, right? So those two things put together are quite large. And then the third, where a lot of people, they just see it as a finance piece, but I think that's kind of just the last piece of the puzzle. I think right now I kind of see them in equal thirds, right? As far as the finance piece and investing and smart contracts and all that type of thing, right? That's a key piece as well. But I think it really is. I think the narrative behind it is becoming that. I think people see how massive it is. It's not just Bitcoin. It's not just Ethereum. It's a whole. It's a whole new asset class from a finance standpoint. It's a whole new breed of technology from a technology standpoint, and it's a whole new way of thinking from a cultural standpoint. And I think that's what I mean, watching the things that I did online, it's a lot of the same from what I've been reading, but every time you watch things, you start to understand, you start to piece it together of how it may work, right? What the possibilities of some of this new
Yeah.
technology is. So, so yeah, I think,
Yeah.
it just got me, I think, a little more excited about it than as just a new way of living versus just the finance side. I'm super still, hey, me, I'm still super excited. I have the hat and everything. I have
Yeah.
the Bitcoin hat and everything. I'm still super excited
Yes.
about it. But, I think the whole space is super exciting.
Yeah, I agree. I mean, I think I would lean hard on the kind of Web 3.0 from my view, and I think that the people that belittle it and think that it doesn't exist are missing the point around the technology that's being built. And I think technology is really what's going to change the game, and I think technology will kind of answer some of your questions in the future when we talk about inflation. But I think technology is really going to change how things are done. And as for the DeFi, the digital finance, because I've worked in finance for 21 years, and I see the pace at what crypto is moving and the pace at which traditional finance is moving, it's they're not even in the same game. So at some point, there's going to be a crossover where, in my view, anyways, where JP Morgan or one of these big majors comes in and says, okay, we get it. We're not just going to participate on the transaction side, which they're doing now. They're putting together the deals, they're doing these kinds of things. But they're saying, we want to buy XYZ company that is like Binance, for example. Not that they're going to buy Binance, but because it's a Chinese company. But they'll come in a company like that, and they'll come in and they'll say, we'll take out this business and we're going to integrate it. And so, at some point, there's going to be a leader in the space, I believe, anyways, that they're going to realize that they need to either be a leader themselves, or at some point they're going to be mothballed. So I think that those are the two that
Yeah, and one
I'd be
of the
most
things
excited
too that I
about.
was reading and hearing a lot about too is a lot of these veterans of the finance world who went to this crypto conference said, uh, this is the first time in their careers, like some of them 20, 30-year careers, where they saw like all the institutional investors, where they like all the big players were there on the ground to like find out more, talk to the people. Probably some headhunting going on. They want the best and the brightest there as well, but just really kind of seeing it for themselves the first time, and they said that's the first time they've seen that in like 20 or 30 years, where you get these big institutional investors that are coming to a conference like this. So that tells you something.
Yeah, and I think yeah, I mean, I started in 99 2000, like at the end of the tech heyday, and there was a lot of that going on at the time too, where the serious money were kind of looking and saying, maybe these businesses are going to change what we do. Maybe the fax machine
I
is
wish
not
it
going to
did. I
survive.
wish it did.
Like maybe
The fax
like
machine
these
and the
kinds.
CD player. Like I have like hundreds of CDs. You know. See, sorry, I digress again.
Yeah, yeah. They smash when you well.
Yeah,
Exactly. Yeah,
yeah.
CD players like Blockbuster, like I mean all these businesses. I think it's a kind of much more of a similar setup to that. And I read the hate on the forums too. Like I spend a lot of time on FinTwit, and really look at kind of both sides, because it's what I do when I'm investing in anything. And kind of the argument is this is just like 2008. It's not. I mean, it's so much more. It's so much different. 2008 allowed to bubble, because the banks controlled pricing. We probably most people who watch or pay attention to any of this stuff is they've watched The Big Short, and you find out when Burry went on the other side of these trades, you find out near the end when he's trying to sell these
Mm-hmm.
things that the banks are just squeezing them, right? Like he knows where these things are priced, and they're priced at ridiculously low levels, but they're just squeezing him because they know he's going to liquidate these things. He's still going to make an insane amount of money, but he knows that like they control it. What we saw 3 weeks ago in crypto was it wash out in 48 hours. Like that whole 18 months that happened in 2008 happened in 48 hours in crypto. Clean the leverage out of the system. Everyone's done. Everyone's out. Whoever lost their billions, they're gone.
Yeah.
The system
that really
didn't
tells you
die.
something, doesn't it? Like a lot of people think that, oh, it's over, and it had its day and it was a good run and that's it. But I think exactly what you said. I think it was just a proving ground, right? And that's exactly, and I think it survived that, right? So, yeah, man, another episode down and another crypto parade for us. That's great.
Well, we got to talk about it. I know. Not everyone's going to be happy about that, but it's just as you think about it, you just gotta see what's happening in the world, and this is an important topic, and I think there's lots of cases for where it applies and where it fits.
And you know what else, Ben? It's interesting.
It's just a matter of getting there.
There's some boring topics and there's interesting topics, and it's interesting almost every time. Right? It's new. It's moving fast. It's new and exciting. It is,
because it's moving so fast.
It's like when you get that new girlfriend.
It's new.
Right? It's the new girlfriend.
But, and there's so many layers.
It's the honeymoon period. It's the best part, right? I guess we won't touch that one. Okay. Ben, I told you.
I'm not touching that.
Today. I'm high strung. It's 2 weeks since we've done one of these.
I don't know.
Let's move on. Do you want to talk about?
That's it.
Kind of fits in there because you mentioned it. You want to talk about inflation because you did mention it in that last little segment there. So what's going on? Everybody's freaking out. Last month's or May's numbers came out. Inflation is higher than expected. What's going on, Ben? Talk us off the ledge, please.
Yeah. We've had commodities on a rope, like you like to say. Commodities have been straight up for 6 months. So, we come on the back of the kind of the slowest numbers in history. So we have oil went negative last year in March, and so all of these inflation numbers are year over year, right? Like what happened a year ago versus what's happening today. You quoted when we were talking before that 5% inflation number in May versus expectations 4.7. And so, I think what is happening from an inflation perspective is we're getting ever so closer to the top end of this kind of move, right? So, what happens when we print, what I'm just looking at Q3 here from Hedgeye's projection. So they're looking at the Q3 print of 392. So say we go from 5 to 392 on inflation. That's not a big deceleration from when you look at the numbers on a basic level, but when you think about that, what that's going to mean to the commodity producers, that's a massive deceleration in commodities. So at some point in the next, in my belief anyways, 4 to 6 weeks, we start to see a deceleration in these prices. And so part of that is we saw lumber kind of sell off, right? And so lumber's been a big contributor as it's ripped up here because housing starts have accelerated. In one of my dailies there a couple of weeks ago, I sent out, we get a big housing starts versus mortgage applications. So you've had huge kind of growth in housing starts. So, your lumber costs have come in. We've got supply chain disruption. So you've had prices skyrocket because the supply chain hasn't caught up yet. And so at some point soon, they're going to catch up. All these companies that were shut down, they're going to catch up. And you're going to have a deceleration in purchasing at the same time. So, I don't think it's catastrophic. I still think we see inflation, but if we're going to decelerate from 5 to 4 or 5 to 375, the market cares about what's happening in the future, not what happened yesterday. So that's a pretty material deceleration. And so we saw wood sell off. We saw copper kind of come off its highs. I mean, I think copper's a long-term secular grower because of electric vehicles. But you've seen a lot of the high flyers start to come off their high levels. I'm not saying it's done, but is oil going to go from 70 to 140 here? I don't know how that's possible. Certainly anything's possible. It's not probable. It's probable it goes from 70 to maybe 75, but at some point, everything comes back online. People aren't going to, necessarily all go back to work tomorrow. I don't think oil is going to skyrocket. Again, possible, but not likely in my view.
I agree. It's a lot of it's supply and demand. I think that the consumer's looking at, right? Like you see, used car or appreciation of the price of used cars, which is it's never happened, I don't think, in history, right? And I was saying even bicycles, like you cannot buy a new bicycle. So like one I was just mentioning before, like a $3,000 middle of the road bicycle that you buy at your local bike shop for $3,000 is now somebody selling a 2-year-old one online for $3,500. You know what I mean? Because you can't get something in that, right? So I think people are looking at that and thinking, oh my God, how are we ever going to be able to afford anything if this is what the used prices are? But I agree. I think it's just going to be once the supply chains open up and we get a steady flow of goods, and I think everything will settle back down. It's my expert opinion.
Yeah. Yeah, I mean, the other thing we talked about too, which is technology. And so if you think technology is going to exist and it's going to get better and faster, technology is inherent deflationary, right? Like if you can take out whole swaths of industries, which is probably going to happen, your costs are going to be capped. If Kathy Woods talked about the electric vehicles and kind of the electric transportation. If that happens, I'm not saying it's happening tomorrow, but that definitely puts a cap on your overhead costs. Like if you can put self-driving vehicles on the road and do a lot of the things that people presently get paid to do, your overhead costs aren't going to go up; they're going to go down.
You know what time it is? I think it's time for bench charts.
Yeah.
I feel like we have to have like music and a graphic to come in. Bench charts.
What's charts?
And I think that's a good idea. I think we got to get that in there.
As we go, we'll get there.
And we can put Ben's boring charts.
Great. Yeah.
For the boring ones. This one, you thought this one was going to be boring. I thought it was going to be too. But you showed me, and it's actually quite interesting. So let's go. Let's throw up the chart, and you tell us what it is.
Okay.
Yeah. Yep, we're good. I can see it.
Should we bring it up here?
Yep.
Let me know when you can see it. We're good? Okay. Listen, I love to talk about, anyone wants to listen to me, I like to talk about risk management in portfolios. This is exciting for me. Right. So this is a little graphic that we can look at, in 1995, which, in hindsight, I wish I managed money through the 80s because it's probably one of the easiest times to manage money because bond prices just went up for a couple of decades. And so 1995, you could have 100% of your bond portfolio or 100% of your portfolio in bonds, and you could earn 7.5%.
Sign me up.
You could sleep well at night. The standard deviation, which, right? Yeah. Your portfolio doesn't fluctuate at all, like tiny fluctuations. And you're good. Like you just go to the beach and you sleep, you're happy. happy. So we have fast forward though 10 years from there, as bond prices continue to go, yields go down, prices go up over that period of 10 years, and now you're stretching to try and get that 7.5% return. Okay, you're still okay. You got a 50-50 portfolio, 50% bonds, 50% stocks. Yeah, the fluctuation's going up a little bit, gone from 6 to 9%. So you're seeing a bit more fluctuation in your portfolio. Now let's fast forward 10 years after the housing crisis, great financial crisis. You still want to get the same returns, and people are getting older. So, baby boomers are starting to think about retirement. I know the chart's a bit outdated, but we're looking for current levels. Rates have continued to go down since then. But now to get your 7.5% return, you need to really stretch out the risk curve. So you go up to kind of a 17 standard deviation, which is a lot of fluctuation in portfolios. So, this kind of portfolio in March of last year would have been down, I don't know, we'll say 30-ish%. So you got $1 million portfolio that drops 300,000. You're starting to feel pretty uncomfortable through that period to get that 7.5% return profile. So it's getting increasingly more difficult to get consistent returns without increasingly stepping up your risk profile. So, I think it's a fascinating way to look at it. I talk about, why do I buy puts in portfolios, or why do I actively manage portfolios? This is a prime example around why you have to do things a little bit different, because if you want to manage that downside, you have to put something in there that's not from the traditional asset allocation
that's from
perspective.
2015 is the latest one. How do you think it would look now?
Makes sense.
Like, we're not 10 years later, but we're 6 years later. Yeah.
I think 6. Yeah. 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 So yields have gotten a lot lower. So I would say that, you'd probably be down to somewhere around a 5% bond allocation. And you'd have to increase your exposure kind of in probably in international equities. So you'd be moving that kind of yellow bar up with a replacement there. So your standard deviations going up into the 20s. So you'd have to increase it there. Maybe you add some gold or some Bitcoin, which could increase the return profile, but also increase your risk profile to do that.
It is interesting. But you know what the biggest takeaway that I took from it is, it confirmed my belief that the 90s were just the best.
What's that?
In general. The music was the best. I looked the best.
Yeah. Right. Yeah. Yeah.
97 was my year.
I bet you got some great memories from 1995.
My life from 95 to 98. I digress. Okay, let's move on. The heyday. All right, let's get that chart off of there.
It was the heyday.
All right, let's move into some fun stuff. Or do you have more to expand on?
All right. Can we?
Okay.
Okay.
Okay, good. All right.
No,
I want to talk
I'm
about
good
this,
on that one. Yeah, let's shut it down.
This article that came out from a publication called ProPublica. You heard about that? You heard of that? Okay, good. Should have heard that before. Okay. Anyway, what does it say?
Yeah, I've heard of them.
It talks about all the richest people in the world, and it kind of breaks down why they paid no federal income tax, or little. I shouldn't say no. Little federal income tax. Okay, just some numbers here I'm going to read off. So Warren Buffett, the true tax rate, right, based off of total income reported. True tax rate, Warren Buffett paid 0.1%. Jeff Bezos paid 0.98%. Michael Bloomberg paid 1.3%, and Elon Musk paid 3.27%. Now, in year 2021, you can imagine how that came off in the world, right? Like, people are not happy about this. Now, that being said, so a couple of questions for you, Ben, the expert of all things finance. How do they get away with that?
Yeah.
I say get away with that, but
yeah.
you know what I mean.
Yeah. So yeah. Yeah. Yeah, for sure. I mean, a lot of these guys have most of their wealth either in some kind of corporation. They probably own most of their lifestyle, we'll say, within a corporation. So you look at you probably look at a guy like Grant Cardone, for example. I know he's not super wealthy like these guys, but Grant publicly talks about the fact that his airplanes are tax deductible. So he doesn't have any overhead costs for running his airplanes, and so it's owned by the corporation. Everything's deductible. Their big properties that they own. Every interest in the U.S. on your mortgages are tax deductible as well. So, hypothetically, say, like even for someone that makes $500,000, if you make $500,000 in the U.S., say you're in like Illinois, for example, your effective tax rate is somewhere around 30%. Then you deduct your mortgage payments, the interest from your mortgage payments, bring your effective tax rate down to maybe 10%. And so there's a lot of tax opportunities that these people have. Additionally, in a case like Musk, for example, he doesn't. They don't take any dividends off the company. So obviously, he's a big shareholder in Tesla and SpaceX. Where Buffett would have to pay some tax around the dividends that he takes off Berkshire Hathaway, but then he'd be a big contributor to charities. So if you make a big contribution to charities, that's a deduction as well. So I think there's lots of opportunities for them to, we'll say,
very safe of you. I think
reduce
too,
their
we
tax.
see articles like this in general, right? I'm just looking at some numbers here, and those numbers, they're basing it off of their wealth growth, right? Like Jeff Bezos' wealth growth was $99 billion. And his total tax paid was just shy of $1 billion, $973 million. So they're giving him a true tax rate of 0.98%, but that's his overall wealth, is of growth of the company. That's not his actually money that he took, right? It's not exactly a fair number, I would say. That's not how the average Joe would, measure how much tax he should
Not
pay,
at all.
for sure.
Not at all.
Right? So not really a fair article. And I find it is 2021, right? We want to cancel everybody.
Yeah. Yeah, it is a little misleading, but yeah. I mean, tax is the thing that everyone's coming for, though. We saw the G7 last week where they're trying to institute this 15% corporate tax rate globally.
Told you.
Like they're coming for people. Like taxes,
yeah, exactly. Yeah. It's going to be Atlas.
So we live in Ontario, though, so we already know.
Get the book. Don't watch the movie. Okay.
Yeah,
the movie's terrible.
Exactly.
What else do we have? The last one I had was man, we just flew through that, didn't we? The last one I had was meme stocks. And the interest.
We did.
Well, a couple of things. You want to talk about? We talked about briefly about AMC. So talk about what we talked about right before this, about how the reaction of what happened with like GameStop and how AMC has approached it differently. Just give a little backstory and then how they kind of approached it.
Yeah, I mean the meme stocks earlier this year with GameStop and BlackBerry and Silver and First Majestic and a number of these companies. When this, I think, first started to happen to GameStop, they didn't really know what to do, how to handle it. They were pretty quiet through that whole process. It wasn't until kind of months later that GameStop really started to think about, okay, hold on a second. We went from being a company that was kind of on the verge of being extinct to the top holding in the XRT, which is the retail ETF in the US. Like, so they've went from something that was irrelevant to the top holding in an index. And so why that's relevant is that, all these index funds, they have to put money into it. So they've put themselves now in a position where even though the business means nothing, doesn't do anything, they're a major player in the markets that they participate in. So GameStop took a while. They finally came in. They announced some new executives. They did kind of a complete overhaul to their business. Then they raised some capital, and then they kind of took a kind of a slow, methodical, like kind of deer in the headlights approach. Where AMC, on the other hand, which obviously is the major movie chain company in the U.S., like these guys were on the edge of extinction. The theaters are closed for a long time. Obviously, they're still closed in Canada, but it started to gain traction in the Reddit room again, and the companies started to go up in value, and the management of AMC realized and reacted quite quickly. They filed a prospectus in April, actually, that said we're going to want to raise some cash sometime in the next 6 months. But right within their prospectus, they were very clear that they said, this represents, we don't understand why the stock is trading at this level. There's a high chance you lose capital if you invest in this business. The fundamentals don't support the stock price. Kind of on and on disclaimers around this. Stock is kind of up 100% one day, kind of drop 30%. They do the raise. Stock rallies kind of 35% the next day after the raise. So they're really proactive on realizing this was an opportune moment for them to raise some cash, put themselves in a position to potentially reinvent their business, or at least ride out the challenge that they saw and that they've seen coming kind of ahead of them.
I don't understand.
So very different approach.
Yeah, I don't really understand how this happens. I don't think anybody really does, right? Is that like what's the whole premise around the meme stocks and why? I mean, it's just like, what is it? Frequent, like momentum trading, right?
Meme stocks. Yeah. So I mean, I think it's evolved. Yeah. So
another
kind of in the 90s where everything was fun.
Mark for the 90s.
The newsletter writers started to come out, right? Everything happened in the 90s. Yeah, so all these newsletter writers came out, right? So, if it was small cap mining, or if it was, tech or whatever, these newsletter writers started to come out. They're we'll call them promoters. They probably would hate that kind of terminology, but they came out with, here's my top 10 picks with a fundamental support. You subscribe to my newsletter, I charge you a fee. Every month I send you out these top 10 stocks. And what you saw, certainly in the mining heyday, is you would see those stocks rip as everyone gets their newsletters delivered. Yeah. And so that kind of evolved into, kind of a number of iterations. Then it became digital, so on and so forth. Motley Fool, like all these different kinds of services came along, and, all of it kind of moved towards where we are today, which is this kind of cancel culture, decentralized, screw the man, like let's find a way to get around this. And so the Reddit system has kind of developed into a 3.0 version of the newsletter, we'll say. And so there's these forums that happen, and so what they tend to be, we'll say, the planting ground, or I don't know if that's the right description, maybe kind of that the ground zero, we'll say. But then, as you probably followed along the way, the Robin Hoods of the world, which are the discount trading firms, the only way these companies make money is they have this feature called the pay for flow. So what they do to all the major institutions, all the major hedge funds in the world, is they sell their order flow to Citadel and the likes to
No.
front run the trades. And not their objective is to front run the trades, but that's what they do. But so Citadel says, okay, we're seeing all this flow come into AMC, and then they have a choice around what they're going to do with it. They can decide where they're going to place that flow. Maybe they want to participate, maybe they don't, but they see the trades before those trades hit the market because they're market makers.
How do we start doing that then?
And so they get their, yeah, right? Yeah, so these Citadels, like these guys, they saw an opportunity in 2008 where the rules were changed, where the banks couldn't continue to take on leverage and capital and be market makers and do prop trading. You know, we've had Tom Savage on there, we had Ryan on, and like these guys were prop traders. They worked for banks, they traded the bank's proprietary capital, they made markets, they front run your trades.
Yeah.
Like they did all of these things that the hedge funds were doing like in the 2000s. Now they're not allowed to do it. And so the hedge funds, the institutions, the hedge funds came out and they're like, wait a second, we can borrow from the central bank at zero. They'll give us, I don't know,
Amazing.
we'll say 100 to 1 leverage.
Like the perfect business.
And we get to front run these trades. I mean, what a great business. Yeah. It's perfect business. But so what happens is the trades get interesting, like AMC. The flow comes though when these guys start trading that market, because when the hedge funds start trading, and we'll say, you know, Melvin Capital, like one of the guys that got taken out, like some of these smaller firms will say, I see Citadel hitting that trade. Like I see Citadel on that stock,
right,
and then they pile on. And so the hedge funds end up are the ones that really drive the flow and momentum of those trades.
Episode there, Ben.
So yeah.
You know, like we've had a little everything.
It's a beast.
I was a little concerned with it going in, but you really stepped it up, bud. So good for you. And
I think so.
If nothing else that I took away from this episode, it is that I want to bring back fax machines. I want to bring back CDs. I want to bring back the laser disc from 1992 or whenever it was, right? And just go back to the good old days when times were easy, right? And I could make money off my bonds and sleep at night, right? Yeah.
That's true.
Well, on that note, thanks for watching.
You got it. Yeah, that's perfect.
Follow,
that's a great analysis.
Or if you want to talk to us, give us a ring on the phone, email us, find our website at heartinvestmentgroup.ca. All of our contact info and direct contact info is on there.
You got it.
Or you can find it somewhere on this YouTube page as well. Okay, that's it. We'll see you next week.